Okay, so this is my fourth clip pertaining to Chapter 18, the Fractional Reserve Banking Open Market Operation Scheme. So what's going on here is we have a private citizen who owns a bond. It's issued, let's say, by the government of Canada. And this private individual now is going to sell that bond to the Bank of Canada. And what we want to do is look at all the different transactions that could go on. And I'm drawing very heavily from Blanchard and Molino's explanation of this. I mean, there are different ways of looking at this, but their way, I think, is probably the simplest and the least confusing. It's still not, super easy, but it's the easiest that I've seen. So let's pretend that I own a bond issued by the government of Canada for $100. And the Bank of Canada now buys that bond from me. Okay, so what happens in this case is that the Bank of Canada pays me $100. And to do this, it creates, out of thin air, $100 of what they call central bank money. Effectively, what they're doing is they're increasing the reserves of the private banks. Okay? Why? I mean, what's going on here? Well, what's happening is it is as if the central bank said, okay, Neil, I want to buy this bond from you for $100. So the central bank runs into the back room, turns on its printer, prints up a brand new $100 bill, right? Hands that to me. I then take that to my private bank, and I give it to my private bank. So the private bank says, I now have $100, so that's an asset for the private bank. But the private bank says, I have to still pay off Neil if he ever comes in to withdraw his money. Right, so from the private bank's point of view, they're getting an extra $100 asset, but an extra $100 liability to pay me. That's the same basic idea, except that instead of saying the central bank runs into a back room, grabs a piece of blank paper, prints up a $100 bill, and says, look, new money, what they actually do is through accounting entries, they just create more reserves. Okay, but it has the same effect as literally printing up new money out of thin air. Okay, and they call it the central bank money, monetary base, whatever, but that's effectively what they're doing. Okay, so what does my bank do? Okay, with this $100 that what I'm saying is they treat it as an asset, as a reserve. Okay, what they'll do is based on that reserve ratio. Let's say the reserve ratio is 5%. Okay, so reserves divided by deposits is 0.05, 5%. What my bank will do is it will say, I don't want to hold $100 in reserves. And it's a suboptimal solution. Here's why. As a private bank, holding all your money as reserves at the central bank means you're earning no interest on that money. And as a banker, the name of the game is to make interest, and that's how this game is played. So we want to take those reserves that are earning 0% interest at the central bank and turn them into some sort of interest generating asset. In other words, we want to change. Basically, the private banks are saying, I want to change the composition of my assets to maximize my interest or profit generating potential. Okay, so what they'll do is they'll say, the private bank will say, I'll take my $100 reserve, and I'll keep 5 in reserve. We'll keep that locked away. That's what 5% reserve ratio means. Is 5% of the is kept locked away. Okay, and I'll take the $95. Okay, and I will pay that to some other person. We'll call that other person Kyle. Let's say the other person is Kyle. And Kyle owns another government bond. So my bank, Neil's bank, buys $95 worth of bonds from Kyle. Okay? So my bank now, at the end of this, has only $5 in reserves. Okay? Think of that sort of like cash. Okay? It's this cash thing. And $95 in interest-generating bonds. Another option here, of course, would be loans. Lend money out to someone to build a skyscraper or something. But it just turn it into something that makes interest, right? Makes income for me. Or, well, I'm sorry, for my bank, right? Because they're the ones who own the bonds. Now what happens is Kyle gets paid off the $95 for his bonds, right? And he goes to his bank, which is a different bank from my bank, from Neil's bank, and deposits the $95. So now this second bank, right, it is saying, we just got a deposit. So we got $95. So that's an asset, reserve. But we also have the liability to pay off Kyle if Kyle ever shows up and wants his money back. Now the second bank here also doesn't want to keep that $95 as a reserve at the central bank. It wants to convert it into some sort of interest generating asset. Okay, but it doesn't spend the full $95. It'll keep 5% of that, or $4.75 in reserve, and then take $90.25 and go and buy some interest-paying bonds that maybe, let's say, Sally owns. Okay? And then Kyle's bank has to pay the $90.25 to Sally. Sally then goes to her bank, which is some third bank, okay, and then deposits her money there. And you can see what's going to happen. This pattern is going to continue. Sally's bank's going to say, well, I have all these $90.25 worth of reserves. I'll keep 5% of that tucked away, and I'll take 95% of that, which is, I don't even know, 95% of 90.25, $85.74, and go buy bonds for some other person. And the process continues. And now remember what I said. What is money supply? It's currency plus deposits. And you see what's going on here is that, you know, I got a deposit when I sold my bond. Kyle got a deposit when he sold his bond. Sally got a deposit when she sold her bond. And in fact, the way this is done in theory is they go on this to an infinite number of processes and keep doing this over and over and over again. And so we keep growing the deposits. Remember what money supply is, currency plus deposits. If we keep growing the number of deposits, we keep growing the money supply. And that's how the money supply grows. It all starts with that first central bank action of buying the bond from Neil. But then through these private banks keep creating these deposits, that keeps growing the money supply. So come see my lecture and we'll go over this in more detail.